Hey, good morning, everybody. Welcome to another daily market report brought to you by Mike Bjork. Today is Thursday, June 20th, and sorry about that delay there. Just having some computer issues here. But anyways, we got a lot to go over today, so we'll jump right into it. Now, the first, obviously, every Thursday we had the weekly jobless claims, and last week was a decent number. We had 336,000 people applying for unemployment. We figured the claims would be, slightly higher at 340, and it jumped up to 354,000. So obviously not too good. That more people are applying for unemployment. And then the other item here is the market flash PMI for the month of June. So we had a 52.3% reading in the month of May, and in June it was pretty close, just a slight dip down to a point, down to 52.2%. So pretty close to where we were in May. And then also we got data coming out of the existing home sales for the month of May, and we had 4.97 million for the month of April. Projected was supposed to go up to about 5 million for the month of May, and it jumped all the way up to 5.18 million. So very good numbers that came out of the existing home sales. And then we also got the fully fed, which is the manufacturing data that comes out of the Philadelphia region. So we had a negative reading, so we had some contraction in the month of May. We figured it would have a slight uptick, but still some contraction shown in June. And it jumped up to 12.5%. So great reading right there. Good for the Philadelphia region, showing some expansion in that region. And remember, we also had the New York Fed, New York Empire, New York region also showed some good promising signs as well. So that's good news for the Northeast region in terms of manufacturing. And last but not least, we had the leading indicators for the month of May. This just kind of gives us a future outlook of where the economy is moving. So we had a 0.6% growth for the month of April. We figured that growth is going to slow down a little bit to 0.2%, and it actually slowed down to 0.1. So a little bit less than what their forecast came in at. And a lot of this, they're still looking at the data from this due to the sequestration we had back in the spring, and then also the increase in taxes. Do they have less money, discretionary money? Are they able to spend money? As well as, are more people going with the sequestration resulting in job losses? Are we seeing more of those? We are seeing, some back and forth a little bit, so there is possibilities there. And then also we've, seen announcements for some of the other businesses out there that we're going to do layoffs and planned layoffs and have not done so earlier in the year, so it might be doing that, now. So let's jump over to the headline news. And currently the stock market's down. Dow is way down to like 200, but I think it pulled back a little bit to about 180. And then also on the global scale, we had the Asian and European markets and gold markets kind of sinking. And a lot of this is, again, all from what happened yesterday after the announcement with the Fed. So they're still panicking as to that he still has the idea of tapering off. Rather than looking at the positive aspect that, hey, the economy is actually improving, that, hey, we're actually going to start pulling away. It's kind of like our welfare situation or a crack person that, if you take away something from them, which is like free money, printing free money, that they're kind of acting like little children and pulling away from it, so acting in a negative manner. So they should be actually happy that we're actually seeing some positive results in the economy and that these quantitative easing has happened or has improved. Instead, they're actually, even though we're getting good news, and that's probably going forward, what they're going to be looking at is if we have good news, that obviously the more likely the Fed's going to go ahead and pull or taper off on the quantitative easing, and you may see a negative reaction towards that. Now, the plus side is that it could help out the bonds in that respect that, they're going to put that money somewhere, and it could go into mortgage-backed securities or treasuries and help interest rates long term. And we'll take a look at the immediate term here shortly. Now, also another item to note is the Chinese PMI continued to decline. They had a 9-month worsening. This was the biggest decline in 9 months. So this is something else to watch. So China's also showing some continued slowdown in their economy. Now we'll jump over the bond market, see what interest rates are doing. So bad day. We had a bad day yesterday. If you watched yesterday's reporting, we had a almost 1.5 points change. So at no point in the morning, basically became costly at 1.5 points, and then we basically are down another 50 basis points. So, again, it's basically 2 points cost at no point in the morning yesterday in 24 hours. Now it's going to cost you 2 points. So in 24-hour period, we're basically down 2 points in pricing for that no point loan as of yesterday morning. So very volatile day here. It's hard to gauge as to where we'll go with this because they're basically, it's all emotional based. There's no logic behind it, and it's hard when you deal with emotion. There's really no set way on how you could project where they're going to go. So keep your eyes open. It's very volatile right now, but right now interest rates have worsened again today, especially after the big hit yesterday. All right, so stay tuned. We do got some. We don't have any economic news tomorrow, so it'll be basically, again, on concerns of probably on the tapering of the QE. But next week we do have some big numbers. We got the GDP coming up. We got consumer sentiment. We got the GDP will be important because it'll be the final revision for the first quarter being reported tomorrow, and then we got some housing data coming out next week. So, all right, stay tuned, and we'll see you guys tomorrow. Thanks for watching.